Welcome to the Property Bible. This show was created for current property owners, people looking to purchase property, and for professionals in the industry. Hope you enjoy. Welcome back to the Property Bible. My name is Kimberly Ackerman. I'm a buyer's agent from Trelease Associates in Sydney. Today we're going to be talking about the fundamentals of a mortgage structure. I have with me here to discuss this topic Mr. Andrew Rose from SmartMove. Welcome, Andrew.
Thanks, Kim, for having me.
You're very welcome. Now, you have been a mortgage broker, you've been in the mortgage industry for 7+ years now.
That's right.
Working with the banks. Yep. And you've been with SmartMove, professional mortgage advisors, for several years now. Is that right?
SmartMove for 4 years, and before that I was in the retail banks.
In the retail banks. Yep. Now, you and I work quite a bit together. Yep. We probably speak every day, if not every second day, with clients.
It's quite a lot, yeah.
It's quite a lot. You help my clients, I help your clients, and together it's such a great synergy. Yep. You're obviously looking after the financial side of stuff, and I'm helping them get properties over the line. So I really respect and value what you do, and you're great at what you do. Yep. You're welcome. But today I want to talk about, I guess, the basics as far as a mortgage is concerned. Yep. A lot of people that I chat to, they're not sure what principal and interest is. They're not sure about the interest rates and how that affects repayments, the LMI, and all these different things that we talk about regularly. But I sort of want to try and break all of that down.
Yeah, no dramas. I mean, there's a lot of jargon out there, and
I
think it'd be good for us to chat about that and sort of explain some of the concepts today.
For sure. So I guess one thing just to kick things off, or one of the bigger topics, LVR.
Yep.
I hear this daily. I know that you do as well.
Yep.
Could you please give people a bit of an outline of what that actually means?
For sure. So the LVR, or loan to value ratio, is so important to banks in their lending, and it's basically the ratio of what a bank will lend to you against a value of a property. So the equation is loan amount divided by property value times 100. That gives you a percentage, and that percentage is what the banks may lend you, depending on a range of variables. So if I can give an example, you might have a $1 million property value and an $800,000 loan. When you use that equation, it works out to 80% loan to value ratio.
80% LVR.
80% LVR,
okay. Correct. All right. And that kind of leads us on to the next topic to discuss, the LMI portion.
Yep.
So when you start to bridge over that 80% LVR and you're getting into maybe 85, 90, 95%, you start to potentially pay something called LMI. Yep. So could you tell us a little bit about what that actually stands for and what it all means?
Yeah, of course. So LMI, or Lender's Mortgage Insurance, it's an insurance premium that is put onto the borrower to protect the bank's risk. So when we're talking about loan to value ratios, the banks are comfortable lending up to 80% generally, because they have a buffer of that 20% in case property values decrease.
Right.
So if a borrower needs to go higher to say 90%, the bank may do it, but they're going to take on more risk.
Yes.
So they're going to apply an insurance premium to you. Some banks do that in-house, some use external insurers, but basically it allows the borrower to get more money, but they pay more for it.
Right.
Yeah.
A lump sum, that basically goes on top of the debt or on top of the mortgage. It's not a separate fee that's paid.
No, it's usually capitalised onto the amount you're borrowing. So it doesn't contribute to the purchase. It's purely for you to repay on top of what you're already borrowing from the bank.
Okay, and that's LMI.
Correct.
So I've heard in the past, and I don't know if it's like that at the moment, but some banks will lend you more than 80% LVR without paying lender's mortgage insurance. Is that correct?
There are a range of lenders that can do that. Sometimes they might offset that with higher interest rates as well. There could be a range of specialty careers and employment that get you exemption from LMI as well. So it's best to talk to a bank or broker about it.
All right, fantastic. Yep. And the next big thing is really principal and interest.
Sure.
So every loan is made up of these different components, but for people who I guess have never had a mortgage before, Could you please give us an explanation of what that actually means?
Yeah, so principal and interest refers to the repayment type, and if you're borrowing money from the bank, they're going to want you to repay that, and typically that comes out as principal and interest repayments, and that's basically you paying off a portion of the original amount you borrowed, the principal amount, plus the interest that gets charged on top of that.
Okay.
And that comes out as a monthly repayment typically.
So your full monthly repayment, just say your monthly repayment is $1,000 a month, for example. A portion of that will be the principal portion, actually paying down the debt.
Yep.
And the other portion of that, however the makeup is sort of put together, is just the bank's interest on top of that.
Yeah, to give you an example, it might be your loan might be $100,000 and it's over 30 years. So the principal and interest repayment is calculated based on you repaying that over 30 years. So you might find that $1,000 repayment has about $50 going off the principal and the rest is interest, especially very early on. And then over time, as the debt amortizes, the shift happens where it becomes more about paying off the principal and less is charged in interest over that term. So
I noticed that's quite interesting with mortgages. Even though the repayments will stay the same throughout the life of the loan, the ratios will basically shift.
Correct. So I guess it's because your loan balance is reducing,
Yep.
and that payment hasn't changed, and the interest is reducing over time. So
Makes
more
sense.
it gets geared towards the principal over that time period.
So you can actually get interest-only rates or interest-only repayments. Sorry, is that right?
Yeah, you can definitely ask your lender for interest-only repayments. It's a little bit different in that the repayment's going to be much lower, but you're not paying off that debt. Effectively, and there's different reasons you might opt for that, but you definitely can look at that option as well.
And from what I understand, one of the biggest advantages of getting an interest-only loan, especially when it's for an investment, say for example, and you're trying to increase the cash flow of that particular investment, getting an interest-only loan, even though you're not paying down the mortgage, which is such a psychological block for a lot of people, they don't like the thought of not paying off their mortgage, but it's increasing in capital value in the background. Most of the time.
That's the main reason. So people may bet that the property value is going to go up, and they're not really interested in paying off that debt because they may sell it in part of their goals in 10 or 15 years. And cash flow is more important, so they want to maintain good cash flow. They might elect interest-only repayments, which can be tax deductible if it's for investment.
Absolutely can be. Okay. I think the next thing to discuss is the interest rates. Now, I don't know about you, but in my experience, a lot of people really hang on choosing an option because it has a better interest rate. What's your thoughts on that?
Interest rate, it's the second most common question after how much can I borrow? And then it's what rate will I get? And we're seeing more and more, like there's a lot of rates out there, it's quite competitive, but sometimes interest rate isn't the first thing you should think about. It should be which lender is going to be the best overall for your goals, long term as well as short term. But interest rate should always be a major consideration, yes. But there's a wide variety out there.
And that's something we kind of didn't say we were going to talk about today, but the fixed and variable is a thing as well. And a lot of people don't actually know what that means. But there are different loans that are set up different ways in that component.
Correct. And it's down to your personal requirements and objectives for every client. So we'd have that conversation with most of our clients or every client about their options, fixed, variable. And a lot of people these days are splitting the loan. So they might have a portion variable, portion fixed. But again, it could be different for an investor. It could be different for an owner-occupier. It's really subjective.
And for people who don't actually know what that means, fixed and variable, it relates to the interest rates.
Yeah, correct. So fixed rates mean that whatever rate you get quoted will be locked in for the term. So you could have anywhere from 1 to 5 years generally.
On a fixed rate?
For fixed, and that means if there's any fluctuations on the variable rates or you hear the RBA is changing interest rates, it's not going to affect fixed rates.
You're kind of safe.
So it's really beneficial for people that are trying to understand their monthly budget, for example. They know what they're spending each month. It's not going to change for the term of that fixed rate loan.
But it works both ways, right? So if if the interest rates go down, and you're on a fixed rate, it stays on the fixed rate.
Yeah, unfortunately, you miss out. So you're sort of betting against the bank.
Yeah.
They say with fixed rates that you think they're not going to reduce any further, and that's when you're locking in a fixed rate.
Okay.
But it's more, I feel it's more for about budgeting purposes, but there are, as I said, some really attractive fixed rates at the moment. There are some restrictions with fixed rates as well.
Yeah.
Generally, there's limits to how much you can repay per year. You generally don't get an offset account, but there are exceptions to that.
Okay.
So with variable, there's no limits to how much you can repay, and you can usually get 100% offset or redraw. In those
And that's
type
the
of products.
thing. You can set your loans up so that it's partially fixed and partially variable.
Correct.
And I think one of the advantages of having a variable loan set up or structure that's set up with a variable interest rate, people don't realize if you do fix your interest rate on your mortgage, if you decide you want to refinance or pull out equity or go through any of that process, you're up for some fees potentially if you're fixed into a rate.
Yeah, that's one of the other setbacks with fixed is that it does eliminate choice to some extent because it can be expensive. If you want to, even if you sell your property and pay out that fixed rate, the bank may charge a break cost if they're losing money. So that's one of the conversations you'd have with your broker or banker is just about long-term plans. And if you're planning to sell within a year, you're probably not going to fix your loan, even if the rates are great.
Yeah, wow.
Yep.
And you mentioned offset accounts earlier.
Yep.
I'm a big fan of an offset account.
Most people are.
Most people are. However, it also depends on the setup
Sure.
and the type of structure.
Yep.
Like you mentioned, not all loans or not all banks
Correct.
and different setups are going to give you an offset account instantly. It's a good thing to ask for if you can get it.
Yep.
But could you give us a bit of an explanation of what is an offset account and how does it sort of work?
Yeah, absolutely. So the most traditional offset facility is just like an everyday transaction account. So the benefit to having it is it offsets money against your loan. So if your loan, for example, is $100,000 and you have $20,000 in offset, the bank's assessing interest on $80,000. So the difference, right? So it's reducing that calculation. And if we go back to the loan repayment at $1,000, that interest component's reduced and more's coming off the principal. So at the end of the day, you're paying off your loan faster, paying less interest to the bank just from having money in the offset.
Yeah, right. So the loan actually, if you have that $100,000 debt and like you said, you have $20,000 in your offset account, the loan sort of thinks it's only at $80,000.
That's right.
In a way.
Yes, correct.
Which is great. And I guess the difference is that money is also accessible. You're not physically paying down the loan. It's sitting in a separate account that's just linked to that mortgage.
A lot of people use it as a form of savings because you're not earning much interest on savings accounts at the moment. They put it in the offset and they're paying less interest on the loan, and it's money they can pull back out anytime for whatever purpose.
And I think that's like, a lot of people don't think about it like that. It's sort of reverse engineering the process. I mean, any money that we earn on a savings account, we're going to pay tax on it to some extent because we're earning the interest, we're paying tax on it. Whereas the money you save is going to provide a very different kind of perspective on things.
I think long term it probably works out better because just basic maths, the interest rate you pay on your loan's higher than what you're getting paid from the bank in a savings account, I think. So that's the best way to look at it.
Okay. Yeah. All right. So I guess the last major component of the fundamentals of a mortgage is equity and refinancing.
Right.
Which is quite a big topic.
It is.
And I don't really want to get into it because it's a lot to go through.
Sure.
So I'm definitely going to have an entire episode just dedicated to equity and how to maximize equity.
Okay.
But I think we'll leave that out for today.
No worries.
So I guess just to provide people with some insight on things that they could do tips wise at the end of this segment.
Yep.
One of the things is for them to know they can adjust their LVR depending on their cash requirements.
Yeah, it's definitely
It's an
important
option.
to speak to the broker or lender about if you need to retain some cash. It's always best to be upfront and honest about your goals and what you want to set out. Like you might have 20% deposit but for some reason you may need to keep some of that back. You might be planning renovations or a holiday coming up, or maybe a baby's on the way, who knows. But
Yeah.
if you're upfront and honest, most brokers or lenders will be able to tailor the solution for you.
Yeah, right.
Yep.
Okay, so LVR is adjustable.
Correct.
If it is adjustable and it hits over that 80% mark,
Yep.
you can look at getting LMI
Correct.
and just having an understanding from your broker or your lender of, how much is LMI going to cost me?
Yep.
It's thousands of dollars, everyone, just so everyone knows. It's,
It's
not
not
a couple
cheap,
of $100
no.
bucks. It's thousands of dollars. I mean,
All
generally
those exceptions.
okay, I'll test you right now.
Okay.
Generally on $1 million loan,
Ugh. Yep.
80 or 90% LVR
Right.
on average, what kind of LMI would you be looking at paying for that 20%?
Look, without giving any advice to anyone
Yes.
or anything
On
being
average.
specific, look, I'd say $15,000 to $20,000. I'd
Yeah,
say, like just off the top of my head, but yeah.
So
gotta
that
check
15 to 20 grand goes on top of that mortgage.
Correct.
And although then you get your 10% free, which is
Yep.
your $100,000 you get to keep,
Yep.
but you're paying a fee for it basically.
Yep.
But you have the option, and that's what I love about
It's about
the
options.
LMI.
Yeah.
Absolutely.
And you pay interest on that LMI as well over the term of the loan. So that's important to
Yes.
understand as well. But yeah, exactly. It's about having options and understanding those options. So,
And there are other options other than paying LMI. You can get a guarantor. There's a few other things that, again, we could spend all day
Equity.
discussing, There's cross-collateralization. There's all sorts of stuff
Yep.
that you can look at doing. But the LMI is there as an option for people to
Correct.
think about.
Yep.
I don't know if you disagree with me, but don't always focus on the interest rates. That's my advice, and I have to stay in my lane as a buyer's agent. But
it's the same advice I'd give is your broker is always going to try and get you the best rate because it's in everyone's interest for you to try and save money as
Yeah.
much as possible. But sometimes interest rate is secondary to getting the loan.
Yeah.
So don't focus on the rate because
Yeah.
a good broker will focus on that for you anyway.
Yeah.
So
And we can ask for cheaper rates down the track.
can always
I ask for
refinance.
cheaper rates all the time with
Yep.
my banks and my
Sure.
investment properties.
Yep.
I literally call them and say, can you do better? And most of the time they drop it on the spot from one phone call. So I think people think that, once you're locked in, unless you're locked into a fixed loan, of course, a fixed interest rate,
Yep.
it does vary quite a bit, and they are competitive
But
with the
even
other banks
that's
as well.
not the life of your loan you fix for. So there's
That's
always
it.
the option to explore another lender
Definitely.
or another rate.
I think the other real big thing is just to try and get an offset account where possible.
If you can.
If you
Yep.
can.
Yep.
With the structure that you're on or that you're on,
Yep.
I know that I've got different types of loans, and some of them, the interest rates are so good, but there's no offset account on them.
Right.
But then I have other interest rates that are slightly higher, but they've got offset accounts that I utilize that
Sure.
are joined to it.
So you're probably balancing it out a little bit there. And look, there are a lot of options again, like in terms of lending, and there could be
Oh, yeah.
low rates, no offset, higher rates with offset. But if you have a good balance in the offset, you're paying the same rate as the lower offer anyway. So
Yeah, wow.
yeah, so
there's-
much to think
There's
about.
lots of different options. Look, I'm a big advocate when it comes to mortgage brokers, but it's good that people get out there and explore their different options, whether it's directly with their private bankers that they're dealing with, directly with the bank, or a broker
Sure.
that they're in touch with as well. I guess the good thing is to understand what are their options
Yep.
for their position.
I
as
think
well.
what you're also saying, Kim, is there's a lot of options out there, and it's good for the customer at the end of the day, whether they go direct to the bank or a broker, as long as they're getting choice and
Absolutely.
options, right?
Yeah,
So that's
choice and options.
Yeah, exactly.
Which gives them the option of choosing what is
Yep.
best for them.
Yep.
I personally have a very high risk appetite, so I like to push the boundaries
Sure.
when it comes to LVR and LMI and equity and all that sort of stuff to get me to my next property goals. But the next person may not like
Correct.
that. They may
Yep.
not be comfortable with that.
Yep.
So always talk to your broker or your lender about what you're comfortable with, what your kind of risk appetite is throughout this process, and what kind of goals you're looking at achieving over the next few
Absolutely.
years. What's the plan basically moving forward? So I think that pretty much covers all of the fundamentals of a mortgage, so to
Yeah.
say, the very basic fundamentals.
Absolutely.
But thank you for your time.
No worries. Thanks for having me.
Yeah, you're welcome.
It's been fun.
I'll probably call you tomorrow about something else.
I'm sure.
About another client. But I appreciate your time. I learn things from you all the time.
Thanks,
and yeah, it's been great. So thank you so much.
My pleasure. Anytime.
So that's everything about the fundamentals of a mortgage. Join us next time. We're going to be talking about what is equity and how to maximize that equity. So look forward to you tuning in.